Hello participants, I'll be speaking on the topic financial statement analysis and fund flow analysis. Friends, you would be reading in the newspapers if somebody wants to invest in certain kind of shares, then what should be the criteria that one should follow? The stock market is touching 33,000 and today you tend to get so many of the news that you should invest here, you should invest in Reliance, or you should invest in Tata consultancy services, or you should invest in Infosys, or you should invest in Himachal Futuristic Corporation Limited, or there are cheap stocks also, there are dirt stocks also, wherein you should invest. So the answer, if you want to invest, the answer you should get in terms of financial statement analysis. Sometimes you are a small and a medium entrepreneur. You have set up a plant and you want to take loan from the bank. Now, the bank wants to see your credit worthiness. The bank wants to see that whether you will be able to, return the loan that they would pay to you, or would it be possible for you to generate that kind of cash inflows so that you will be able to return the loan. So then, what should the banks do? Similarly, uh, a new company has come up into the market and it is providing some kind of raw materials to certain companies, and they want you to have your company to have a long term relationship with them. Now you want a long term credit for them. How will these companies or your traders, how will they decide, these suppliers, how will they decide whether they will give raw material to you on credit or not? So if you want to get all answers, then the answer to this is that you should go for financial statement analysis of the company which now wants to deal with you. Whether you are an investor, or you are a banker, or you are a stock supplier, or you want to join a company, whether the company will be able to pay your salaries, your wages, or how the company is doing in terms of the profitability. So even if you are an employee, you should go through the balance sheet of the company. So therefore, friends, different stakeholders are interested in different aspects of the company, and the simple answer to all their queries is that they should go through the financial reporting part of the companies wherein they would like to be interested in. So these reporting should include the balance sheet and the profit and loss account. Similarly, government also is a stakeholder wherein government will be interested to know whether you are paying your taxes or other regulatory mechanisms also. So the analysis of the balance sheet, analysis of the profit and loss account will give some kind of idea to all the stakeholders that whether they would continue to, or they would start up a relationship with such a company or not. So friends, what is financial statement? Financial statement of companies are summarized financial reports which provide the operating results and financial position of the company. So this would include, as I've already said, a balance sheet and a profit and loss account. A balance sheet is a statement of what the company owns and what the company owes. So in a nutshell, or in a common language, or a common language parlance, we may say that it actually depicts the net worth of the company. What are the assets that the companies have, and what are the liabilities that the company has, which it owes to the others. Similarly, the other financial statement which is very important and which is included in terms of financial statement analysis is the profit and loss account. In profit and loss account, we study the profit and the loss of the company. We would study that what is the profits that the company is generating, what is the revenue that the company is generating, and what is the expenses that the company is incurring. So if we study these two reports part, if and along with the fund flow and the cash flow, so this gives us a total a much better position of what is the financial health of the company. And different stakeholders, mind you, are interested in having or knowing the financial health of the company. so as to forge a relationship with the company at a later stage. Now, what is analysis? When we say analysis is a process which examines the past and the current financial data of the company or of the firm or of the enterprise to know or to evaluate its performance, to know whether the company is financially sound or not, and to estimate future risks and potential of the company. It is basically a study of relationship amongst various financial facts and figures as given in a set of financial statements and the interpretation thereof to gain an insight into the profitability and operational efficiency of the firm, to assess its financial health and future prospects. Therefore, the idea is that if we are interested to forge any kind of relationship, best would be, rather than not jumping into the wide sea with both the hands, with both the feet in the water, we should take calculated risks. And first to that, we should go into do some kind of a research. And the research would be to study the financial statements of this company. And while we study it, this will throw light on the strength and weaknesses of the business enterprise or the firm, and this will help us in making decision whether we would like to have a kind of a relationship with this company or we would not like to have a relationship. And mind you, as we have talked about, different kind of stakeholders, they see different kind of aspects of the company to know how the company is performing. And suppose we'll discuss it in some detail while we go by. See, while we have talked about the stakeholders, so different stakeholders here could be investors. Firstly, investor is a stakeholder. As I said, if you want to invest in TCS or if you want to invest in Infosys, we should know it should not be on the tip of your stockbroker. Rather, you should go for a fundamental research. You should know whether the company is solvent enough, whether the company is liquid enough, and whether the company is able to generate profits in the long run, so that if you are an investor, your money should come back with interest to you. Similarly, if you are a creditor, you should know why you should lend to this company. And the management is also interested, because the management, they may be employees or they may be the top management, they are all interested in the well-being of the company, because in the well-being of the company is their own well-being. So therefore, they are also there. Then the security analysts, as I've said, who are the investors and who advise people. It may be a mutual fund company or it may be a FII, foreign institutional investors. They are all interested to know how the company is doing, what is their future plans, how will they be able to perform in the future, so that they can advise it to their clients that you may invest it at this kind of a risk. Then banks and FIs, today even banking is a challenging proposition. We know what is the kind of NPAs that the banks have created. So banks should not, or rather would not be interested in lending to somebody wherein their money is not safe and secure, and it may turn into a non-performing asset. So therefore, they are also interested to know how the company is doing. Now, how to go about this? I mean, all those rosy plants and machineries, all those rosy buildings, all those rosy machineries, and even the land and all those assets may not hold good if the company's revenue position is not so good, if the company is not able to generate profits, and therefore they should also go through the balance sheet. Similarly, taxing authorities, the auditors, the regulatory agencies, even your labor unions and even your customers are interested to know how the company is doing. So therefore, all these stakeholders, they have one thing in common, that if they go through the financial part, if they go through the financial analysis of such companies or enterprises, they'll be able to know that how the company is doing. Like I have just talked about in the beginning, the top management of the firm would like to go into all aspects of financial analysis. The reason being because it is their overall responsibility to see that the resources of the firms are used most efficiently and the firm's financial condition is good. Uh, the banks, the FIs, the government, all these are side players. But who's the main player? It is the top management. The top management has to provide the vision, the leadership, and they have to provide the supervision. They have to see that if they have n number of resources, how these resources are being utilized, and they have to provide a vision and a direction to the company so that the company is able to do well. And therefore, if they go through the entire thing, that will, the certain gaps and the ideas will be given to them, that look, this is your strong point, this is your weak point, and this is how you should strengthen. Similarly, for the employees, the finance manager, whose role is to get the finance at the cheapest rate for the company, and if they want to invest, the company wants to invest, they have to invest it into the most profitable kind of a business. So he is responsible for making decisions for the firm, and these decisions have to be rational in nature. So the decisions have to be in terms of managerial performance, how to improve managerial performance so as to improve the profitability, how to improve the corporate efficiency again, so that your profitability becomes good, your revenue becomes good, your overall expenditure goes down. Then they have to see whether how you have to improve your financial strengths and how certain weaknesses or shortcomings have to be reduced. Then his role is also to improve upon the credit worthiness. So if they approach the banks for and FIs for certain kind of a loans or financial assistance, that is readily given to them. Similarly, as I said already, that trade payables who want to have a relationship with you in terms of providing you the supplies. See, they would like to see the short-term obligation of the company to repay their goods. If they have given some kind of goods to you in terms of raw materials on credit, so for a time period of 30 days, 60 days, or 90 days, they would like to see your liquidity position. They would like to see that whether you will be able to repay what you have promised in terms of 30 days or 60 days or not. So again, that's a different kind of need. They'll look after the liquidity part of the company. Similarly, banks and FIs, they will look after the profitability over a period of time, whether you'll be able to generate cash, because banks and FIs generally will be lending to you for long-term loan, for setting up assets, for creating assets in terms of land, building, machinery. Then they'll also see whether you will be able to generate cash for a period of maybe 10 years, 12 years, or the currency of the loan. They'll also be able to see whether if you will be able to pay them the interest and the principal, and what is your capital structure, they'll be interested in. Similarly, your investors, as I said, they'll be interested to know what is your earning, what is your profitability, what is your future profitability, what is your risk structure, what trends are coming about, how is the leadership all about, what is the quality of company's earning, whether the company's is so good and the leadership is so envisioned so that it is able to get projects, it is able to generate profits, and what is your past performance and what will be your position in the times to come. So therefore, all this information can be derived from simply seeing the financial statement analysis of the company. Now, if you talk about the applications, so applications of financial statement analysis will mean providing that data, providing that information to all the stakeholders for making decisions. These decisions could be in the nature of operations. I mean, what is your risk? What is your return? What is your dividend or interest yield? What is your safety? What is your liquidity? What is the growth? Then it also provides you information whether to continue or discontinue the main operation, whether to diversify, whether to expand. Then it will also tell you that whether you would like to make or purchase certain materials or you would like to get it from others. Then it also tells you whether you should go on rent or machinery or lease a machinery. Then this also provides you information that whether you would like to issue stocks or that means you're the equity part, or you raise debt from the market or from the bank or the FIs. Then they will also tell you then how to make decisions regarding investing or the lending of the capital. So therefore, if we talk about this provides you different kind of information to take different kind of decisions, wherein all these decisions can be taken in a prudent manner after studying the balance sheet. And mind you, just studying 1 year of balance sheet will not be enough. 1 year of profit and loss account will not be enough. If we have to study, we generally suggest all the stakeholders to study at least 3 years balance sheet, if not more. Otherwise, one can go for 5-year balance sheet just to see what trends are, just to see how the companies have behaved, just to see how the companies have come about. Similarly, there are various tools that are available. Now, the second question that arises is that how do we study a balance sheet? Balance sheet, as you know, it to a layman, it is a very complex kind of a document. A profit and loss account is a complex kind of a document. So, how to study this kind of a document? Generally, I would advise you, there are 3 ways like how you can study it. One is the horizontal or a dynamic analysis, other is a vertical or a static analysis, and the lastly it's a financial ratio analysis. So I'll explain it in a bit what these are and how things are. But it will just give you an idea of how to actually go through it. So you can take the financial statements and compare it for 2 or more years for the financial data. So this I am talking about the horizontal or dynamic analysis. And then while we have this 2 or more years data, then we can concentrate on the trends in the accounts in rupee value and percentage terms. The idea is that in horizontal or dynamic, we can take 2 3 years balance sheet and take the trends part. We can see that how they have behaved, what is let's say revenue. Supposing for the year 2015-16 revenue was 100 crores, and for 2016-17 it becomes 120 crores. So it is clearly visible to us that the revenue has increased. Let's say if the profit, if the expenses for 2015-16 was 40 crores, and for 2016-17 it became 45 crores. So we could see that with the increase in revenue of 20 crores, the expenses have just increased by 5 crores. So this is a good trend which is therein. And if we just, and it is all hypothetical, and if it is, if in 2015-16 the profit is 20 crores and it has increased to, let's say, 25 or 30 crores in the year 2016-17, it shows a healthy trend wherein all three aspects have increased. But this is hypothetically, you may or may not get such kind of figures available. Similarly, we have to see the capital structure. Similarly, we have to see what are the assets available. Similarly, whether the assets have increased or decreased or whatever aspect. Now, there's another method of doing it that we term as a vertical or a static analysis. Herein, everything is in terms of a percentage. It's a common size statement. Everything is in terms of a percentage. A material financial statement item is issued as a base value, and other accounts of financial statement are compared to it. So 1 year and one item you can take as the base, and all other aspects can be compared to it to find out whether the company or whether the business has done well or whether it is in doldrums. Last part, wherein another way of doing it is, and which is very much used by all financial institutions and banks, FIs, and even the certain kind of investors like mutual fund or FIIs, they use financial ratio analysis. This is not only simple, but it also is very effective also. As you know, ratio analysis. Ratio means we compare one to the other, and these are financial ratios. If we term of what is ratio analysis, just a minute for this. It appraises us the position of a business by comparing things. It identifies trouble spots that need attention, and it also helps us to make projections and forecasts about the course of future projections. And there are various kind of ratios which one can study in terms of financial ratio analysis to study the health of the company or health of the firm. Generally, as a layman or as somebody who has lesser knowledge, and we get hold of a financial report like a balance sheet or a profit and loss account, if we have to know the health of a company, we should study liquidity ratio, we should study asset utilization ratio, we should also study inventory ratio, solvency ratio, and profitability ratio. See, if you go by the 5 ratios which are important, and in these 5 ratios there are certain formulas, certain ratios which you should know, that once you go through it, you are able to find out that how the company is moving, whether the company is in the right direction or whether the company has some issues with this. Liquidity ratio, as you know, it tells us about the obligation, the maturity of the company or a firm to pay its short-term debts or obligations. Whether this means that whether the company will be able to repay its short-term obligations or not. If we stretch it, this means that, like I was talking, a supplier gives you some raw material on credit basis, and you have to pay him after 30 days. So the supplier has to see whether the company has that much amount of liquidity, that much amount of cash, that much amount of funds in the short term to pay these short term obligations. Similarly, employees, whether if somebody is working for a company or a firm, he would be interested to get his own salary. So if the company is able to repay his salary on the first of the coming month, then for the employee, the company is good. So the employee can see whether the company would be able to repay his salary or it may not be able to repay his salary. So liquidity ratios, if you go by, will provide you certain kind of inputs wherein you tend to know that what is the liquidity position of the company. Liquidity means whether the company has cash resources or whether the company has such resources wherein they are able to repay their funds in cash manner in the short term. So therein you tend to find first is the current ratio. Current ratio generally if you say by it means current assets over the current liabilities. So if you go in the balance sheet, there is a column which says current ratio, current assets, and there is another column which says current liabilities. So if you divide the current assets along with the current liabilities, you will tend to find that what is the ratio, and it should be greater than 1. If it is negative, so then that means the company does not have current assets to pay its all current liabilities. Similarly, you have quick ratio. Similarly, you have net working capital. Net working capital would hereby mean the total current assets that the company has. So in the short term, whatever the current assets the company has, they are there to repay the certain obligations or debts of the company. So therefore, the company should be able to repay its debt in the shorter run, and if we go by the balance sheet, we will be able to find out this aspect. Now another ratio that we find out is the asset utilization ratio. See, asset utilization ratio reflects the way in which a business enterprise uses asset to obtain revenue and profit. Herein, see, this term will give us the ratio about operational efficiency of the firm. Operational efficiency means that how the company uses its raw materials, its resources, its manpower to generate the product and then to sell the product to get the revenue and thereafter the profit of the company. How the company can increase its revenue and how the company can reduce its expenses. So, and you know very well know that if the company is able to manufacture things and sell things at the right time and also get the money from the pocket of the buyer, then that money can be rolled into the business. And if it is not able to do so, then the asset utilization ratio will be lesser, and that means that the company is not able to do well. So higher the ratio in this case, the more efficient the business. So therefore, this can be seen. Then is the inventory ratios. Inventory, as we know, I have one full module on inventory. Inventory, as we know, means uh, the working capital part, wherein the company has certain kind of raw materials, the company has work in progress, the company has finished products, and the company has to sell, the company has to convert this raw materials into the finished product so that they are able to generate profits, they are able to sell it up, and they are able to generate revenues for the company. And mind you, uh, the inventory part, the inventory as such, has to be sold in the market, then only they will be able to get their revenue and the profit back. And if it is hold up, if the inventory is held up, they are not able to generate profits, not able to generate the revenues, then it is a lag on the company. So if we see these inventory ratios, somebody who's with the company to invest in the company or to see what is the position, liquidity position is, they'll be able to know whether the company is able to do well here or not. And if the inventory ratios are lesser, that means the company is not able to do well. Then there are the solvency ratio. Solvency ratio, as we know, is to measure the ability of the company to meet its long-term obligations. Mind you, just remember the liquidity was to see the short-term obligations of the company. Solvency ratio is to see whether the company will able to meet its long-term obligations. So herein, all those people who have lent to you for a longer period of time, or who are with you for a longer period of time, like banks, financial institutions, long-term creditors, or even the investors who would like to put money in you for 5 years, 10 years down the line. So they would be able to know whether the company would be able to generate profits for a longer period of time, whether the company has that kind of a leadership, whether the company has done well as per the trend analysis. And if the answer is yes, then they would be able to invest money in you, pay you loans, give you loans, or to give you any kind of facility, credit facilities for the future. So if you have to do this, then there are certain ratios which you should go through. One ratio is the debt equity ratio. Debt equity ratio, if you go through the balance sheet, the capital structure of the company, you will tend to know what is the total debt, and what is the total equity. Debt is the loans that the company has taken, and equity is the promoter's contribution, or it is the money in terms of the stock, or it is the money that the promoters or shareholders they have pooled in. So if it should not be more, because if the debt is more, then you have to service the debt also. So this will reduce your profitability in the long run. So that has to be seen. And similarly, your promoter's contribution. If the promoter's contribution is more, the promoter will have more interest in the company, and he will be able to put in more effort, more ideas, and he'll have more at stake. So therefore, the company is bound to do well, because the promoter will put in more effort into this. Next is your profitability ratios. Now, if we go through the profit and loss account of the company, we'll see that, as I said, that what is the revenue, what are the expenses, then revenue minus expenses will give you profits. Then you have to go for depreciation also. You have to see certain tax structure, taxes that have to be paid. So herein you have to see these ratios will tell you whether the business will be able to generate profits after reducing or after minusing its expenses or not. Or second part, it will tell you that whether the expenses has increased or whether it has reduced, and whether the company is able to reduce its expenses or not. So there are various ratios which you go through this. So one of the ratios is return on investment. So this will tell you how the company has done well. Then return on equity. And see, the idea is that if you get more higher value relative to a competitor's ratio, then you should go for the company which has found higher ratios in terms of the profitability part. Similarly, this was for the financial statement analysis. Now another part is the fund flow analysis. See, as a business, as somebody who's investing, as I already said, stakeholder, you should be able to know, you should be able to go through the entire financial reporting, which will have on one hand the balance sheet, the profit and loss account. The third important report that you should study is the cash flow analysis and the fund flow analysis. Fund flow, as we know, is the net of all cash inflows and outflows in and out of various financial assets. Generally, maybe see, there's one word as a window dressing, which we use in the accounting parlance. What is window dressing? Window dressing is that the balance sheet may take the shape which is actually not the shape, meaning thereby that some smart chartered accountant or some accounts person may be able to show certain things in the balance sheet which actually it is not there, and it is very difficult to catch hold because you cannot go through all books and all of the people. So the smart bankers or the FIs or even investors, what they do is they ask, from apart from balance sheet and profit and loss account, they ask for the fund flow analysis or cash flow analysis of the company also alongside these documents, because these two documents alongside fund flow analysis provides a good platform for for the investors and other stakeholders to actually go through and make decisions whether the company is doing well or whether the company is doing. Herein, it could be a quarterly or it could be a monthly fund flow. Herein, all kinds of cash inflows and all kind of cash outflows are reported. They are documented in fund flows analysis, fund flow statement, and you tend to make decision. Then you can actually compare it in a bigger picture of profit and loss account and the balance sheet also, just to see whether whatever has been reported is in the right direction or it's in the not the right direction. Because if we have to go through for the entire year, then it is the balance sheet. Then profit and loss account could be quarterly also, it could be half yearly also, but at the end of the day, we see it in the annually also. But fund flow analysis coupled with profit and loss account and the balance sheet will provide us good measure to see whatever has been given to us by the promoter, whether the information, the data and everything is correct or not. So it gives the entire inflows are taken, entire outflows are taken, and then we can further make decisions on this count. The purpose of the fund flow is to provide information about the company's receipts and payments for a specific period of time. So friends, at the end, I would just like to say that these are very important documents, the financial reporting part.
Hold. जो black चाहिए ले